So hopefully you all remember your risk profile score, which depending on your time horizon and your risk tolerance, put you somewhere either as a conservative, moderately conservative, a moderate, moderately aggressive, or aggressive. If I recall, many of you landed in the moderately conservative and moderate categories, which is surprising to me because I would have expected many of you to land more in the moderately aggressive and aggressive category based solely on your time horizon. So like when you will need this money from an investing perspective, as well as, well, yeah, that's my primary driver. So this was also on the PDF that you have, where it's showing kind of as a conservative investor what you can expect to get in an average annual return, all the way up to being an aggressive investor. But I also want you to see, I think it's important to look at what the worst years are, right? So the more conservative you are, the less heartache you're going to have, right? Because your worst on average is about 5%, okay? Which is not good, but it's manageable. Whereas if you're aggressive, you can have years where you lose more than a third of your investment, and that should cause you to want to get in your bed, put your head under your covers, and cry a lot. And it should, because that sucks. But remember, when you're playing the long game, you're going to have these 36% losses. You're also going to have these 40% gains here as well. So a better way, and I should also say each one of these, right? So here are 5 different types of investments. I just want to explain this a little bit. So equity, remember, stocks, right? So investing in large companies, small companies, investing in companies that are international, having some sort of fixed income, we'll talk about that today, and investing in cash. And so what you can see, in all 5 of these strategies, right, there's some sort of large cap investment, there's some sort of cash investment, right? So that gets back to this concept of diversification, spreading out your investments amongst different types of investments. Your portfolio, spreading out your portfolio among different types of investments. So you can see here that here you're more focused on finding things that are relatively safe, okay, as well as holding a lot of it in cash. Where here, you're not looking, there's nothing that's on the fixed income side, and most of it's in stocks. Okay? So I want to point that out to say that you want to make sure that you're being, and this is just an example, right? Please don't take these numbers and say this is what you have to have, but it's kind of giving you a sense of how a conservative person would invest versus a more aggressive person. I also lay this out, conservative, moderate, and aggressive, because when you're conservative, you're primarily focused on just having a stable account balance. You want a clear idea of kind of what your investments are going to be, and that's more important to you than making a lot of money. Okay, risk versus reward. You can't have great reward and take little risk, right? Those 2 things just don't work together. When you're aggressive on the other end, you're willing to have those days when you have to put the cover over your head because there's going to be those other days when you've got a 40% increase, right? So you're willing to assume a higher degree of fluctuations, ups and downs, in the pursuit of having growth opportunities. You want your investments to grow, right? Where moderate is right in the middle. You're willing to accept some types of fluctuations, right? Some ups, some downs, because you want a higher return, but growth is not your primary objective. Any questions on these three broad categories: conservative, moderate, aggressive? So what we're going to do over the next couple of weeks is talk about the different types of investments, from low risk. So the more conservative you are, this is kind of where you want your money to be placed, versus high risk. The more aggressive you are, this is where you want your money to be placed. Okay. So when we talk about low risk, we're talking about cash, CDs, money market, mutual funds, government bonds. Level two, that's kind of safety, fixed income. We're talking about more about bonds from corporate and municipalities. There's some stocks in there, some conservative mutual funds. As you get into more of the growth, you're looking at smaller size companies, mutual funds or stocks and mutual funds you can invest in, rental property, like real estate. And then when you get into speculation, you're talking about buying derivatives and options and buying contracts to have the right to purchase. You're gambling basically in the market. So today we're going to cover as much as we can. We're going to talk about some conservative investments. And I put this quote investments, I put investments in quotes because you're really, the more conservative you are, you're not really investing, right? This is really a savings account, right? So you can't expect to have tremendous growth in these areas, but these are nonetheless investment opportunities for you to pursue. I moved too fast. Are there any questions about this slide here? Are you all writing? Should I hold for a second? I can hold.
Do you recommend we write a lot of this down?
No, not necessarily.
Okay.
I shouldn't say that as a instructor. I mean, no, because if you want, I mean, I know I haven't been consistent in posting the slides, and I said I would, but I am posting the videos, and so you can always go back and take a look at the video and take a picture of it or something like that. But it's a lot of stuff on here, so no, I wouldn't expect you to write all this down. But I just want you to get a general sense of kind of all these different, a general sense of all these different investment strategies you can pursue, and the greater the risk that you take, right? Which ones have the higher risk, which ones have the lower risk, which turns into the higher returns, the lower return, or the higher losses and the lower losses. So we'll talk about investments. So today we're going to cover CDs, certificates of deposits, money market funds, government and corporate bonds. So I got to tell you all, here's my investment strategy. Okay, it's called the KISS strategy, which means a lot of different things. But today it's going to mean keep it super simple. Okay? So whatever investment strategy you pursue, okay, it has to be simple. Okay, this is just my approach. So one, you should never buy a product or a service or that you can't explain to someone how it works. Okay? So if you can't explain how stocks work, and you will be able to, if you don't already, you shouldn't be investing in stocks. If you can't explain how bonds work, or how a derivative works, then you shouldn't be investing in that. I like this term, financial product or service. Everyone selling you an investment is selling you something, and they're selling it to you because they're making money off of this product or service. So you have to keep that in mind, that they're in the business of selling you something, convincing you to buy something. When you get into things that are overcomplicated, that's when you have the risk of getting into some trouble, right? Or losing a big ton of money. And the book that Everyday Millionaire points out that most multimillionaires have a simple, even a boring investment plan. Okay? It's all about doing the same thing over and over and over and over again for a long period of time. I have a cousin who used to ask me. He used to ask me for advice in investing, and he would say, "All right, I want to start investing. How do I do it?" And I would say, "Man, just whatever you can take, $50, $100, and just invest it in the S&P 500. Start buying shares every month." And he goes, "No, that's not what I mean. I want to make like a lot of money, right? When I get this much money, how do I want to make that? How do I want to invest that?" And I go, "Well, don't wait till you get money. Just start now. Take $50 and invest it. And I told him, yeah, you put $50 in, that can get you $5 more at the end of the year. What are you going to do with $5, right?" And so he stopped asking me because he wanted something more sexier. But I just think the approach is consistent and it's simple. All right, so CDs. I know we've talked about CDs before. So CDs are something you purchase at the bank. They're an agreement to loan money, right? Basically, you're giving the bank your deposit, and you're saying, I'm agreeing not to access this for the next year, 2 years, 3 years, 5 years, right? In exchange for that, you're going to give me a guaranteed interest rate, right? So the bank is playing this game saying, we think that if we get Erick's $10,000 and hold it for 3 years, and pay him 2%, we feel like we can make more than 2% with his money, right? Much more, right? We can earn 6%. So that way, we're earning 6%, we're paying him 2%, we win, right? So that's the game that the bank is playing with me. I'm playing the game that says, I feel like the market's going to decline. If I can convince them to give me 2% over the next 3 years, I feel like I'm going to come out ahead, because otherwise that $10,000 would be sitting either in a savings account, right? And it's earning very little interest, which is not guaranteed. Plus, I have to fight inflation, right? The things, what $10,000 3 years ago is not worth the same as $10,000 today. Or it's in the stock market and it's losing a lot of money. So that's, and the other advantage with CDs is it's insured by the federal government. So up to $250,000. If that bank were to go under, and you don't get this with investments, but if the bank were to go under, the federal government would give me that $10,000. So CDs as an investment. It is a good idea if you are in a low tax bracket. Okay. If you want no investment risk, if your primary goal is just preserving capital, I just want to have this money available, I don't want to lose my $10,000. If you have a specific use for that $10,000 3 years from now, that's when you graduate, and or that's when you're going to get married and you plan to use that for your wedding. And you can lock in that rate. You say, hey, 2% is good enough for me, right? It's a bad idea if you are losing money after you factor in any taxes you'll have to pay on that, and inflation. So if inflation's rising at 3%, then having an investment at 2% is not it's not a good idea. Or if your primary goal is growth or income, that's not going to cut it, right? 2% of $10,000 is not going to help me. Even when you start compounding that, it's moving at a very, very slow rate of return. Any questions about CDs? Any questions about the image? Playing
would you
with
say
the memory
that
match game and playing with
CD
matches? No. All right. Moving on. Money market funds. Okay. So this is a new one. So with money market funds, okay, and what you're doing is you're taking your money, you're pooling it, or you're combining it with money of others, and then you're using that money to purchase short-term investments, right? So you're buying CDs, commercial paper, treasury bills. All these things have very low interest rates, but they're also relatively safe. Okay? If I can explain just a little bit more, right? So there's a minimum investment amounts in a lot of these funds, right? And they say, okay, if you want to purchase this type of corporate bond, or you want to purchase this type of treasury bill, you need to, or you want to purchase this CD that's earning 2% interest, you need to put down at least $25,000. So I don't have $25,000 to invest. Okay? I've only got 10. But if I've got 10, and then you've got 8, and then you've got 7, if we pool our money together, right? These are what funds are. We pool our money together. Now, collectively, we can afford to purchase this CD for $25,000. So it increases our purchasing power when we pool our money together. Does that make sense? So again, you're not getting tremendous returns, but that's okay, because the purpose again here is more about capital preservation, right? Just holding on to my capital, my investment, my $10,000. And it's not so much about growth or income. The difference is, right, because 1% to 2%, that's not a lot of money. But if I just had $10,000 and I just kept it in my savings account, I'd be earning less than 0.5%. Or if I had that and I want to put it into a CD, well, if you need $25,000 to get this 2% rate, and I don't have that, then the best I'm going to get is going to be like 1%. Okay? So by putting it in with others, right, we're able to purchase bits and pieces of more lucrative investment products.
Putting it in with others?
Sorry?
Putting it in with others?
Right. So we're all kind of combining our money together
Okay.
in order to purchase these different types of investments, short-term, low-risk investments.
Okay. Short-term. All right. Yeah, sounds good.
So these, and So one example is VMMXX. So this is an example of a Vanguard money market fund. So if you were to go and type in your, I think you could just pick up your phone and type go to Safari, your thing, and type in VMMXX. It's going to give you information about the money market fund, okay, for Vanguard. And I'm not promoting this, right? I'm just giving you an example of what the money market fund looks like. Let me see if I can do this on my computer. This might be more helpful. I can't see that. Oh, there it is. So I just typed in VMMXX, and this is Vanguard's money market fund. And money market funds always have the same price of $1. And you can see this one is earning, it's not earning a lot, 0.86%. Okay. Very low risk, very low reward. Okay. Minimum investment, $3,000. Okay. But you can, if you have a Vanguard account, or if you have a Fidelity or an E-Trade or TD Ameritrade, you can just log into your account and say, I want to purchase $5,000 of this investment. Okay. Again, I'd rather have $3,000 earning 0.86% than have $3,000 sitting in a savings account earning 0.2%. But again, it's not about this right here is not about income or growth, right? This is more about savings, but it's just earning a bit more.
All right. And it's not harder to then reaccess that money if you need it?
So thank you for asking. These are very easy to access. They're treated somewhat like some of them have like check writing features. The money market funds that I invest in are tied to my brokerage accounts. And so when I sell shares, the money goes out and goes back into that money market fund. When I buy shares, I buy them from that money market fund, right? So I'm kind of that's money where I'm just parking until I make another investment decision.
Okay.
But yes, they're easily accessible. I can log into Vanguard or Fidelity and say, I want, send me $2,000 or $3,000, and they'll transfer in the next couple of days.
All right.
The other thing to show you is right here. If you go down, this tells you what they're invested in. So 4% of their investment is in CDs. 34% are in U.S. Treasury bills. About 50% are in Yankee foreign. I'm not exactly sure what that means. Then you got U.S. commercial paper, U.S. government bonds. So you can see kind of what they're investing in as evidence that it's relatively safe. Okay. And then here they're showing you their annual returns for their account versus on average. And surprise, surprise, they're doing better than average. If I were putting together a chart, I would make it appear that I'm doing better than average as well. The average is just the average of all the funds that you decide to put into your average calculation. So anyway, I'm not hating on it. I know, although it sounds that way. We got a question. Are all the money market? Yes, all the money market funds have low returns because basically you're just investing in short-term, low-risk investments.
Right. Okay. And if you invested in something else, then what's the difference? Something that isn't short term.
Well, you have a higher risk and you have the higher probability for return.
Right. Okay. And this is the one that you're recommending for a more moderately conservative, investor kind of person?
If you are not recommending anything.
Okay, right, yeah.
If you are a conservative investor, then your primary goal should be, I want to preserve my capital, right? The money I got, I just want to hold on to it. And I'm not concerned about making a whole lot of growth and income off it. I just want to know 5 years from now, the $50,000, the $20,000 that I put into that account is still there. So that's what a conservative investor is. This is a way to achieve that, is with money market funds.
Okay.
Someone asked, do the money market funds have management fees? They do. Let me show you. I can go back to that screen. I skipped that one. If you go right here, this expense ratio, they're charging you 0.16. So that's less than a quarter of a penny for every dollar that you have invested. So if you were to invest, I'm just going to do some math here, 3,000 times 0.0. It would cost you $4.80 to invest $3,000 in this product. Other questions? Oh, I shared the wrong thing. So back when it was okay for me to cough in public and we were meeting in person, we talked about money market accounts. We were talking about different types of savings accounts. So now we're talking about money market funds, right? This is a mutual fund that's investing in short-term, low-risk investments. So the differences are money market funds, these mutual funds are not FDIC insured, right? So if I was investing in a CD, my $10,000, and that bank went kaput, I can go to the federal government and they'd get me my $10,000. If I'm investing in a money market fund, okay, I cannot go back in that brokerage account, that brokerage firm, Vanguard, goes under. I can't go to the federal government to get that $10,000 because I'm making an investment. Money market funds charge fees, and money market funds do not have any withdrawal limit. So I think someone was asking, how easy can you access it? You can access the money relatively quickly, and you can access as much as you need at any given time.
Mm-hmm.
Questions?
So the funds are the ones that are not FDIC insured. Just trying to understand it. When you have a brokerage account, what can you do with that in relations to with both funds and accounts?
So a brokerage account is, so first you need a broker, stockbroker, Fidelity, Vanguard, right? So I think at the very bottom of that Google page, it said open an account, right? So you open that account and now you have a brokerage account. You
Yes.
use that brokerage account to invest in the stock market, buy mutual funds, buy individual shares, purchase options, all this type of stuff. But in order to purchase it, right, you have to first take money out of your bank account, out of your savings account, and fund and put money into Vanguard or Fidelity, right? And so they're holding that money. Is that making sense?
Uh-huh.
So when they're holding that money in a money market fund. So it's earning a little bit of interest while they're waiting for you to tell them what to do with the money. Buy this mutual fund, buy that mutual fund, sell this mutual fund. And that money is just being parked with the brokerage account in a money market fund.
Mm-hmm.
A money
Okay.
market account is where you go to the bank and you go, hey, look, I've got my savings account, I've got my checking. I still want to have access to my money, but I want it to earn just a little bit more than what I'm earning in my savings account. And they go, oh, well, why don't you use a money market account, right? You need to have at least whatever their number is, 5,000, 10,000, 20,000, whatever. But now we can give you more, we can pay you more in interest because you're holding money with our bank, but you still have
Right.
access to it.
Okay. And is there a big variety in how much money you need to have saved in your checkings and savings for them to, well, get you a money market account?
I think it's going to vary bank to bank.
By a
Yes.
lot, like many grands.
I don't know. I don't know if it's by a lot, but I know it's going to vary bank to bank.
Okay. Always more than what, 2,000 or 5,000?
I don't want to say always.
Okay.
If you're, I feel like you're trying to back me into a corner, so I'm just going to get into the corner and say at least 10,000.
All right.
A deed of trust. I'm assuming that's for. I'm reading the chat room. What kind of investment does a deed of trust fall into? I would assume it's a deed to property, real property. So that would be real estate. If you have a deed of trust into a, a boat, I guess that's also real property. Are they safe? They're safe, yes, because if you have a home, right, that you own or that you're living in or you're renting, the house or the land is going to be there. You're required to have insurance, so it's not gonna. You don't have a risk of it like going to zero. There's always going to be some level there. The problem with real estate is it's not liquid, right? So if you decided that you needed access to, say you got your $1 million home in Livermore and you need access to $10,000, can't really. I mean, there's ways to do it. There's not ways to do it without going into debt. You can't go in and get $10,000 out of your $1 million home investment and then go pay off something, right? You'd have to end up going into debt, home equity line of credit, in order to get access to that $10,000. So they're not liquid. You are welcome. So let's talk about bonds, right? So bonds is that level 2 type of financial security, right? So we're moving from just safe, like I just want to make sure I have all my cash, to I'm willing to take some risks, right, in order to get more to get a higher return, but I don't want it to be doing a whole lot of fluctuating. So I want to show you a video of how bonds work. Okay, so let's watch this video.
Common investment. However, to many investors, they remain a mystery.
Can you guys hear that?
Bonds are a common investment. However, to many
Can you hear that?
investors, they remain a mystery. So let's explore what a bond is and how it might benefit your investment portfolio. A bond is simply a loan given to a company or government by an investor. By issuing a bond, a company or government borrows money from investors, who in return are paid interest on the money they've loaned. Companies and governments issue bonds frequently to fund new projects or ongoing expenses. Some investors use bonds in hopes of preserving the money they have, while also generating additional income. Bonds are often viewed as a less risky alternative to stocks and are sometimes used to diversify a portfolio. Consider this example. The city of Fairview wants to build a new baseball stadium, so it decides to issue bonds to raise money. Each bond is a loan for $1,000, which Fairview promises to pay back in 10 years. To make this loan more attractive to investors, Fairview agrees to pay an annual interest rate of 5%, which in the bond world is also known as a coupon rate. An investor buys the bond at face value for $1,000. Now, let's fast forward. Each year, the city of Fairview pays the investor $50. These regular interest rates continue for the length of the bond, which is 10 years. Once the bond reaches maturity, the investor redeems his bond, and Fairview returns his $1,000 principal investment. This bond was a good deal for both the city and our investor. Fairview got the money it needed to build the stadium. The investor received regular interest payments and the return of the original investment. Because a bond offers regularly scheduled payments and the return of invested principal, bonds are often viewed as a more predictable and stable form of investing. Compare regular payments of a bond to the experience of owning a stock. With stocks, profits and losses are driven by market forces and are generally less predictable. Of course, like any investment, bonds are not without risk. One risk that bond investors face is the possibility that the issuer defaults on paying back the principal. This is what is known as default risk. Typically, bonds with higher default risk also come with higher coupon rates. The amount of risk depends mostly on the financial stability of the issuer. For example, most governments are generally considered stable issuers and issue bonds with a relatively low coupon rate. Corporate bonds typically represent a greater risk of default, as companies can and do go bankrupt. That's why corporate bonds often offer a higher coupon rate. Several credit rating agencies assign rankings to different bonds. This can help bond investors to gauge the financial strength of the bond issuer. These ratings agencies often use different criteria for measuring risk. So, it's a good idea to compare ratings when considering a particular bond. And keep in mind, rating agencies aren't always accurate. So be sure to research a bond and its risks thoroughly before investing. Another risk to consider is interest rate risk. This is the risk that interest rates will go up, and any bonds you own will be worth less if sold before the maturity date. After all, when interest rates rise, more investors allocate their money into the new, higher interest rate bonds. If you wanted to unload a low interest rate bond to take advantage of these new rates, you would have to sell your bond at a discount to make it a worthwhile purchase for another investor. Capital preservation and income generation are just two ways bonds might be part of a diversified portfolio. Many investors use a mix of stocks and bonds to pursue their investment goals. And because bonds move differently from stocks, they can help increase or protect portfolio returns. Keep in mind that this discussion showed you one simplified way that investors might use bonds, and only a few of the risks to consider. Like all investments, bonds are complex and have a variety of uses and risks. Before you invest in bonds, it's important that you invest in your own financial education.
All right. I'm thinking you have a lot of questions.
Yeah, so it was showing when it was like a semi-graph thing where it's like a line going up for stocks and a line for bonds. I think that's the rate that it goes up until I mean, the stocks seem to be like sporadic or, unpredictable, whereas the bonds, as they're saying, they're like yearly you get the same return or the money until it went down. But that was just for them to demonstrate. So, so it's always, I don't know how to put it.
Yeah, so
That
that line where it was showing it like going up and then it just dropped would
Yeah.
be the assumption that the the government or the municipality or the corporation where you purchased the bond from
Uh-huh.
went bankrupt.
Okay. All right. And so then I was thinking it would be safer to get a bond with a government before something else because, well, the U.S. government, its bankruptcy is not something that is likely.
Yes, and yes, exactly. And that's why this is considered a more safer investment because the U.S. government has never defaulted on their loans, right? So it's a loan. A bond is a loan, and what you're saying is, I'm going to loan you this money. In exchange, you're going to pay me a certain amount of interest, an agreed upon set amount of interest every year for the term of this loan. And then when the loan expires, or at the maturity date of the loan, you're then going to give me back all the money that I loaned you. You're going to give me back a set amount. Okay. So yeah, the government doesn't default because the government has this thing called in San Francisco on Market Street called the Mint or the Federal Reserve Bank. And they just, we owe Eric $50. Somebody go down there and print a $50 bill and give it to him. So they do. They print more money.
And they mentioned that there are, I guess, agencies that rate certain bonds, like give them a assigned AA or BB minus, something like this, but that they're not always, what was it that they said, credible or right? So how do those appear when you get a bond? Is it on a sort of paper or, how can you find out, if, how do you find out what rating maybe the bond you're getting has?
So you can search for it online, and they'll show you what the rating is for that bond, and they'll probably show you an average of kind of what different rating agencies have rated that bond as. And as you can imagine, right? So we're still talking about risk and reward. So the lower the rating, right? That means you may or may not get your money back, but that also means that they're going to give you a higher interest rate, right? So you're going to earn more because you're taking more of a risk.
Right. And the time that it normally takes to get back your principal, I think was what they said, the total amount of money you gave them, does it vary? Because there, I think it was like 5 years, something like that, or maybe 25.
It does vary. So each bond issuance is really, it's a contract, and the company is creating this contract with its investors, right? And then you're deciding, do I want to invest for 5 years? Do I want to invest in here for 7 years, et cetera?
Okay. And would it seem, I don't know, more beneficial to invest in a bond that is that you're going to get your principal back for a very long time because you're getting back perhaps more money, but that does depend on the rate, now that I think about it.
Yeah, depends on the rating.
Mm-hmm.
There's been some questions in the chat. I'm going to read those off. If the bond interest rate is below 0, is it worth investing in it? if there's nowhere else to invest, then I guess I'd say yes, right? So you'd have to ask yourself, how much lower, how much below zero is it, right? So if the inflation rate is, you know, is at 3%, which means I'm losing money, and I can invest in this bond, then that limits what I'm losing from inflation. But I would say at this point in the United States, it's not worth investing in a bond that has an interest rate below zero, because I can invest it in my savings. I could leave it in my savings account and earn 0.25%. And I'd rather earn 0.25% than earn -%. Someone says, where can we buy a bond? From a brokerage account. So you can open up a Fidelity, Vanguard, E-Trade, TD Ameritrade, that was their video. And then you can go in and say, I want to purchase this bond. Have we covered exchange trade funds? Not yet. Yes, that's my answer. And that's G's answer as well. Not yet. If a city is a issuer and the city temporarily got bankruptcy, what's going to happen to the investors? Will the investors get their principal when the city gets back to normal? Oh, great question. So if a city files for bankruptcy, kind of similar to how when we file for bankruptcy, they're looking at, okay, who are all their debtors? Who do they owe money to? And let's figure out how much they have in assets and how we can best allocate these assets to all the people they owe. And so with the bankruptcy, basically it says, and once we're done with this process, you're not going to owe anybody anything. We're going to take all your assets and use it to pay off all of your liabilities. Okay. So you ain't going to have nothing. I mean, you'll have a little bit left over, and you ain't going to owe nobody nothing. Right. So that's kind of how that would work. So it depends. So when it gets back to normal is going to be like, we don't owe you anything when it gets back to normal. And with the principal that you'll get back, it'll be probably a percentage of that, of what you've given them, depending on who else they owe money to. And I see a couple video heads shaking. Yes, I get it. All right. So thank you for letting me know. I can stop talking. All great questions. Any other questions? So I want to show you all kind of what this would look like. So treasury bills are a type of bond, and you can purchase them in 4 weeks, 13 weeks, 26 weeks, 52 weeks. You can do treasury notes, 2 years, 3 years, 5 years, 7 years, 10 years. Treasury bonds, 30 years. And you can see how often they're paying interest, right? So when we think of bonds, the most safest type of bond is a U.S. government bond, right? Because they will print money to make sure that you get paid. But that also means that it's going to be at a lower interest rate as well. So I'm reading the chat, is the 529 the best investment account to save for my daughter's college? We haven't talked about 529s yet. We haven't talked about that yet. But a 529 is that's a good place to invest for colleges. But even if you have a 529 plan, you still have to decide, am I going to be conservative, meaning investing in CDs, money market funds, bonds, or am I going to be more aggressive and invest in large cap equity or international equity? Does the interest influence the principal? Interest? I don't think so. The principal, no, I don't think so. The interest is set by contract. And then what influences how much interest you get is if you buy one bond for $100 or you buy 1,000,000 bonds for $100,000. So that's what's going to influence how much interest you get. But they're going to set that interest rate at the start of that contract. Oh, these are great questions. These are the bond ratings that we were just talking about. You don't have to memorize these, but just I want you to get a sense that an A or AAA is very good. B's are okay, and when you get to C's, those are like junk bonds, right? You are, even though you're investing in a bond, you're at the very top of that investment pyramid where you're speculating. No one else believes this company's going to last, but I do. So I'm going to get the higher interest rate and get my principal back. Let's see. State and local governments also issue bonds. That beautiful building that's sitting empty right now at Positas College, building 1000, that was built using funds from a bond. So those of you that live in Hayward, Castro Valley, Livermore, and wherever else that district is, you had to take a vote, and you all voted yes to allow Chabot Positas College to go out and take out this bond, where they said, we want to increase our campus and build new buildings, and we want to have your permission to do that. And you all said yes. I live in Alameda. Ironically, last year, Alameda had the College of Alameda had a vote, something on the ballot to vote to have their bonds issue bonds, and I should have voted yes. I voted no. I'm a no voter, so I probably should have voted yes. So one thing to know with the state and local governments is the interest that you earn may be tax-free. In other words, you don't have to pay taxes on that interest that you earn. With the federal government, the interest is tax-free. So when you're thinking about like, well, how much money am I making? How much money am I making off this investment? Remember, if you're investing in the stock market and you have a gain or you receive dividends, you have to pay taxes on that, right? So that needs to be factored into how much money am I making on this investment. Whereas if there was, if you're making money off of a federal bond or state bond, you do not have to pay taxes on that. So, if you make $1, but you have to pay 20 cents on that dollar, you really only made 80 cents. Whereas if you make $1 in tax-free interest, you actually made $1, right? So you can see the difference between 10% return, but you have to pay taxes on it, versus a 9% return where you don't have to pay taxes on it. What are
the only difference?
Oh, go ahead. Question.
The only difference being the one where you don't have taxes on it is from the government or a investment for them.
Yes, when you're investing in that state, in that, or in that government or municipality, they say you don't have to pay taxes on this. We'll waive the taxes.
Mm.
Question, what are some companies that pay relatively good dividends? In my opinion, I do not have, I don't have a list of companies specifically, but when we talk about mutual funds, there are mutual funds that you can invest in that are all dividend companies that just normally pay dividends. I think Coca-Cola is an example where they always pay dividends out every year. And so you can invest in just a bunch of those companies all at once to earn the dividends. Now, just to say this, that when you're earning dividends, what you're probably not getting is the growth of the stock value. So there's always going to be trade-offs, right? You're either going to say, I'm invested in this company like Google, who's never paid dividends, but I bought when they were at 200 and now they're worth, 1,000. So when I sell it, it's an $800 windfall. Or you can invest in companies like Coca-Cola, where you're earning, the stock price is not jumping up significantly, but what you are getting is you're getting money every quarter, every year through the dividends. And it looks like Tyler's putting in some companies. BA, I think, is Bank of America. J&J is probably Johnson & Johnson. Not familiar with EQM. And then there are corporate bonds. Okay. So when you do corporations, companies can also issue bonds, right? And so the reason why a company would issue a bond is because they're looking to grow their business. They're looking for some additional capital, and instead of going to a bank, one specific lender, right, to get $100 million, they say, hey, let's go ask 100 million people to give us $1, right? Or 10 million people to give us $100, right? And so it's the same financial need, but they're spreading it out amongst a bunch of individuals instead of going to get that money from one bank. Questions? I want to show you what this looks like in practice, but with 5 minutes, I am not going to start talking about bonds and putting a bunch of numbers on the screen, because I think that would just make your head spin. So what I'll do is I'll take the last 5 minutes of class and let you all continue to ask me questions.
I already saw you. Get out.
All right.
Sorry.
I'll let you ask me questions if there are any, and then we'll pick this up on Monday. There are. I did look, and a lot of you have not finished the homework for Module 4 on debt. That is due on Friday. So if you like suspense in your life, you can wait until Friday morning to go work on it. But we all know that the internet has not been as reliable as we've liked it to be over the past month. And we all know that things have gone down over the past month. Websites have gone down. So you don't want to be in a position where Las Positas' Canvas site crashes on Friday, and then you have to email me and go, oh no, it crashed. Then I want more time. And I go, but you had 2 weeks. And blah, blah, blah.
Canvas says it's due Saturday at 12:30.
Okay.
So have it done by Friday at 12:30?
I think you should have it done like now.
So
You want to wait till Saturday morning to work on it,
So when I tried for the link for the chapter for the 4.1 homework link for that, it says error.
4.1.
Yeah.
Okay, I will go in and look at that and fix it.
Sure.
Mine worked.
All right. Any other questions? All right. Well, I guess that's it for today. That's it for this week. Look forward to seeing you all on Monday. Have a good weekend.
Monday.
Thank you.
Have a good
Thank
weekend.
you.
See you later.
Bye.
Good weekend.
Bye.
Bye.
Professor Bell.
Goodbye.
Bye.